When the next extreme happens, and this is what I'd be looking for, as you know, if you know what the real estate cycle is, you are looking for 14 years up off the lows of the US real estate, which was back in the beginning years of the prior decade. So, we're now looking towards 2026, 2027 for things to start to look interesting.
One of the things that I'm most interested as an investor is sleeping peacefully at night. Now, that's not always easier said than done, but since finding Akhil and Phil's work, it has really helped me. Now, one of the things that I'm super grateful for is you guys have gone and done the hard work of looking at 200, 250 years worth of data in the American markets in terms of the previous economic cycles, booms and busts. And so my question today for today's video is what's coming over the next 6 to 10 years, and how can investors like myself or yourselves, safely set themselves up to take advantage of whatever potential growth is coming around the world, but also knowing that at some point in the next 10 years, there's probably going to be a pretty hard market to move through as well. Big question, loaded question, but let's just sort of tackle it moment by moment.
Akhil, you want to jump in? I mean, I've got me personally, I actually don't think it's that hard to see what's coming next. I know that sounds a little bit facetious.
You call it remembering the future, right? Because you've learned from the past.
Yes. So let me describe it this way. Number one, get educated. You have to get some sort of understanding. The best way to do that is to understand the real estate cycle and how it's constructed. In other words, it's based around the enclosure of the economic rent. If someone doesn't understand that, if you don't understand it, I urge that person just spend a little bit of time and get educated on that. It is the best thing you'll ever do because, as Ben, as you've discovered, it gives you the structure of how the economy works. Once you get that structure, I know from all the people I've taught before, and Akhil's been speaking with and taught as well, you can sleep better at night. There's absolutely no doubt about that.
I actually legitimately sleep better at night, like I do.
Yes, because you can see what the structure is. It allows you to see through the economy and especially see through the bullshit that we get from politicians and government. Absolutely. I really sincerely mean that. They lead you down the wrong track through emotive and emotional behavior. And there was no better example than Donald Trump. He was telling people how great he was right at the top. You can't get suckered into that. So that's the first thing. The second thing is the things often, they don't appear what they really are. So let me give you an example of that at the moment, just for the next year or two. Long bond yields, they're going to rise a little bit at the moment, and they have and they are already. I don't get suckered into the belief that they're rising. They're not actually rising. I'd like to put that in a slightly different technical term. They're retracing the down move. They have to rise a little bit. And in that environment where yield curves, and again, if anybody watching or listening doesn't understand what the yield curve is, get educated. It's not hard. It only takes a couple of minutes of elbow work, and with our members and subscribers, we do that for them, as you know, when you've been getting our stuff.
Can I just point out something there really important to people that haven't been following you as long as I have? You mentioned that there was going to be the inversion in the yield curve. I think it was almost 18 months ago.
Yeah.
And you said that with every inversion within 9 months, there's almost been a technical or deep recession for 100 years. Now, the yield curve is so simple, and I'm nowhere near as quick as you guys are on this stuff. It's when the long-term bond and the short-term bond meet, and there's an inversion point, and it's just a precursor of in the past something that's coming. Now that happened, I sort of thought, well, everyone freaking knows about the yield curve thing, and because of that, there's not going to be a recession. And like clockwork, with almost 9 months to the day, it worked out. So it is powerful information that's super easy for people to learn about. You can read it on your website in about 2 minutes and get it.
That's right. Now we've got the opposite. Now we've got a bit of a steepening, which means that it's a bit easier for banks to make money, which is what the government and the federal what the Fed wants, because at the end of the day, they now want more lending and more credit creation. So now that might lead to some people in the stock market panicking a little bit, because they'll say, oh, if yields are rising, it might mean the stock market sells off. But just for the next year or two, we're in a position where the yield curve is steepening, but provided, and this is usually the case when we're coming out of some sort of downturn or recession, earnings of listed companies will increase more than the yield does, which in the end is bullish for stock markets, and that's what markets are pricing in at the moment. So you'd expect over the next little while yields to retrace a bit, but earnings to increase, and that'll hold up valuations. That's the next year or two out. Then I think after that we'll get pretty serious with the infrastructure kicking in. We've got to build more. You'll start to see talk about tallest buildings and lots more roads and rail and especially in America, why they've got, it's a first world country with a third world infrastructure service and a fourth world healthcare system. Everybody outside America knows that. So Biden's now got a chance to improve that. That's very bullish as well.
In the Commonwealth Bank update in Australia, just from the Australian perspective too, just came out and said that 2% of the GDP is going to go into infrastructure. And Commonwealth Bank's words are, this will create the biggest boom in Australian history if they follow through on their word, which it's almost 100% guarantee that they're going to. Like, I've never ever seen something come from CommBank talking about a government-driven infrastructure boom. They reckon unemployment rates are going to be below 5% in Australia within 18 months off the back of what they're doing at the moment.
Yes. Now that then after that, and we are extrapolating a little bit here, years into the future. But again, you just extrapolate years into the past, and that'll tell you what the future is going to do. And of course, if you've read my Secret Life of Real Estate and Banking book, which details the prior 11 cycles.
You need to print a bunch more of those books to be honest. They're bloody hard to find. I reckon I've had 200 or 300 clients spend over $100 go find them. I'm putting Phil, it's time to get some more printed out there. Let's do it.
The publisher is Shepherd Walwyn. They've got quite a few on hand, so if you just go directly to the publisher, they should be
cool.
Should be pretty easy, but I'll look into it. You might have noticed that certainly almost the last 30 years in a way, since 1982 or 1983, perhaps longer, after most downturns, the banks around the world, governments around the world have been able to get away with lowering interest rates a lot, and that's all good. When the next extreme happens, and this is what I'd be looking for, as you know, if you know what the real estate cycle is, you are looking for 14 years up off the lows of the US real estate, which was back in the beginning years of the prior decade. So we're now looking towards 2026, 2027 for things to start to look interesting. If that does happen, then to get a sustained downturn after that extreme, it always comes back to rising interest rates, really. So you'd have to be on guard, because after 2026, if we do start to see a bit of a sell-off and a bit of a downturn, the banks and the government, they're going to do what they always do. They'll try to lower interest rates.
How can they do that at the moment? Like by 2026, where do you forecast rates could be for retail investors like myself?
I don't think it'll be much different than what it is now. Perhaps it's relative. Try not to get hung up on the actual precise number. Things are relative, so it'll be relative to inflation and relative to expectations and things.
So they might be pulling them back from a 5%, for example, back down to a rate relative to now to try and get us through the next one type thing, just theoretically.
Yeah. Well, that's the theory, and that's the textbook stuff, and it's possible. But two things. The debts are now... I've never worried about debts before. I've always said to people, you don't have to worry about debt till everybody else does, and that usually happens, as we know from the real estate cycle, about every 18 years. They are significant now, and it is something we should... They're just... I've never seen them, so it's unprecedented, really. And that's
household debt or government debt globally?
All debt. Debt everywhere.
Yeah.
Debt everywhere. So the thing... the only trouble will happen if there's an event or two that does not permit either the United States, especially the United States, or other countries from actually being able to lower rates. And one of those events that could stop the US government from having the ability to lower rates is if they got a currency crisis, whereby that's when the US might be considered a third world country, or like what a third world country is, where they have to keep raising rates to protect the currency, or to protect the lowering dollar, or to protect whatever currency it is. And things start to get out of hand that way. So I don't know what the event will be. I just know the timing on it. You'd have to start to look for something. But if we get to a situation where, for some particular reason, the event that takes place starts to make it really hard for the government or the Fed to be able to lower rates like they really do, that's when you could see a panic, and that's possible after 2026. Yeah, worry about that if it happens. Yes.
So from what I've seen from you guys, you're sort of saying, 2021 is hopefully the start of a recovery. We get to about 2023, 2024, and we might move to almost like a bit of a winner's curse phase of the cycle. And then historically, but again, these things can be 1 to 2 years either way based on history and reading your book. So 2026 would be a point where you'd be sort of suggesting that people are in a semi-stable position to be able to weather a bit of a storm if one's going to come through.
Well, I could, as you know, I could go on about this for hours, but I think what just laid out for you is the framework. So, and you notice how nowadays, if you're reading the news, to hyperinflation and it's just not sustainable and so on. And we're saying, well, what you really should be focusing on is increasing company earnings, which is why the stock market is increasing. At the peak of the cycle, we will have all sort of somehow convinced ourselves that this thing is going to go on forever. And we'll be saying the opposite. We'll be saying, well, actually look out for a trigger event that might, make everyone sort of wake up to the amount of debt that there is, how high land prices are, how overextended things are. So I think, to go back to your original question, Ben, the point is that if you study history, you can develop this framework. It's relatively simple when you get down to it. So just about following how the yield curve moves, what's going on in the land market, what's happening with inflation, printed to acquire real estate. And it's not just governments that print money, it's also the private banking system does that as well. When's that gone over the top? And when it has, you know that you are ready for some kind of correction. And it's at that point that you want to make sure that you can weather the storm. You might have cash on hand. You are not over leveraged. If some of your rental income went down, you still could service your debts. You wouldn't be forced to sell in a bearish market when things aren't looking good, because obviously then you'd be forced to sell at a low price. You just have to do relatively simple things, but the key piece of knowledge that you need is to understand the structure of the real estate cycle, as Phil said, and it's laid out very clearly in his book, The Secret Life of Real Estate and Banking. He takes you through the history for the entire history of the United States. Sets out each cycle. He gives you the framework at the end. I'm also writing a book, hopefully it will be published this year, where I basically kind of copy what Phil said. Saying at this stage of the cycle, this is what you're doing, this is what you should be looking for, and this is what you should do about it. So some sort of practical information as well.
Now you're going to be doing the Fred Harrison thing with that book and sort of pointing towards 2026 and making a forecast that you can put your hat on for the next 70 years of your life? Or are you not being that bullish and just putting it all on the line?
No, I will. I mean, I've been writing about this stuff for, sort of 5 or 6. I think actually the first time I wrote about it was with Phil. We did a Money Week article in London in 2014. We put it out all on the line then. So, if we're wrong, we're wrong, and we're, but if we are wrong, that means that something has fundamentally changed about the economy.
The thing is,
And
guys,
we've
at any
also-
point you could be wrong. Like, I'm playing devil's advocate here, but I'm a cynic and a skeptic, the same as you guys both are. There's a healthy level there. The only thing that would be wrong is the dates, right? Like, you know, the whole structure is still the same. People do really, really silly stuff when they don't understand the flow of money into assets long term, and at some point it's always going to go over a top because human nature just cannot help itself.
Ben, sorry, Akhil, I just cut in a bit, but if I may, the one thing I learned from writing my book, I've said this before, the one thing I learned, which is giving me the confidence to say such things in public, the one thing I learned is things happened and things had to happen to make the real estate cycle complete and finish. And we are seeing this at the moment. Despite interest rates being so low, the debts have risen to astronomical proportions. So only one more thing has to happen, really. And as we go forward into 2026, the time frame we're looking at, things have to happen to bring absolutely everybody into the stock market, and at the top for people to have absolutely no cash left because they're so heavily invested. Mm-hmm. And look around you, what's happening? Robinhood, people getting feeling as though they've missed out on stuff. The newspaper's full of the prodigious $100 million gains that they've made. We've got a lot of new investors in the crypto area, which is an area that that nobody really is a specialist in. Anything's possible. Anything's possible. Imagine if Bitcoin goes to $1 million. I'm not saying it will. I mean, imagine the aura and what goes into the media about this. And then remember, because the real estate cycle structure teaches you, at the top is when things look at their absolute best, but underneath the structure is when it's at its absolute weakest, because everything's built on credit and nobody's got any cash left because we're all in. We're absolutely all in. And then the final thing that will complete the whole structure, and I don't wish to be sinister here, but history's proved it, governments, the Fed, central bankers around the world, if there's something happening behind the scenes that might be revealing the weaknesses in the structure, they will do absolutely everything to make sure it doesn't become public. Mm-hmm. And that's the thing. See, that's why you have to know the structure and you have to know your history.
I love that, Phil. One question. Actually, there's two things I wanted to say that, if you don't mind, that I heard literally today. So one of them was from my auntie. She's just booked one of the penthouses for her birthday in the Gold Coast. Now, this place, which was the world's tallest apartment in Australia in 2007, it opened up, sold for $9.5 million. Just resold in 2021 for $5.6 million. 40% loss over 12 years plus no effective gains. It was just another perfect example of don't buy the hype. Because they've just announced three of the tallest buildings in Australia have just all been announced in Melbourne to open up in 2027. Literally all of them been fast tracked to get us out of COVID and to create jobs. That was interesting. The second thing that I heard was an investor from Sydney, because I've heard you guys talk about the satellite cities around Europe, America and Australia, which, seem to do better in the second half of the cycle. I've seen Sydney and Melbourne prices run up by 80% in the last 10 years, but prices in Brisbane and Perth are legitimately cheaper to buy than they were 10 to 12 years ago right now. I'm sure there's cities in the UK the same, and I'm sure there's cities in the States the same as well. Sydney investor gets on the phone this morning to an agent that we know. This house was online for $590K, sold for $800,000, and the guy said, "Is that enough?" And the agent was like, "Yeah, that's enough. $600K would have been enough," but he's not going to tell the guy from Sydney that doesn't know the Brisbane market that. And so that creates a new standard in the suburb. And this is the cycle legitimately turning in front of everybody's eyes right now. It's as clear as day. You always said that there's a new technological invention, which is clearly cryptocurrency, where you guys are starting to call that mining, because effectively it's a new resource in a way. And there's going to be an unprecedented amount of people that make money there. Some of them will be smart enough to pull it out and put it into something else, stock markets or properties. And, it's incredible. It's just really cool. So my last question will be, what specifically with your own money are you guys going to be investing, and what's your asset allocation going to be between property, business, and stock markets over the next 5 to 6 years to take advantage of this stuff? Because that's the question that so many people have out there. How much do I do? What do I do? You know, who cares what we're trying to do? What are you guys actually going to do with your hard-earned money over the next 5 years?
Well, I mean, I think we've said in a previous video that you kind of go for things that you know well. I mean, investing is not a business where you basically just stick your money in something and, 5 years later, it will suddenly magically have increased. I mean, there are some stories like that, but there's not much credibility behind them, and it's not very common. So the answer to your question really is there's no sort of pre-programmed allocation. What we're saying to you and your listeners is that there are going to be many opportunities along a whole host of asset classes, from commodities to real estate to stocks to cryptocurrency. You've got to know what you're doing. You've got to study it. You've got to understand, how to buy and sell and what to buy and sell.
So you would recommend people stay in their circle of influence and actually specialize in a couple of things that they're going to take advantage of over the next 5 years?
Yeah, I mean, they can expand it to more than a couple of things, but I think you mentioned off air that you were going to learn how to, the stock market works and focus there. I mean, that's exactly the approach you take. You understand real estate very well. You want to diversify some of your earnings and your investment returns. So you learn about the stock market. We've covered some of the areas which you might want to look for as a stock market investor. And that's exactly the way to do it. I mean, personally, I don't mind saying that, I invest in real estate. I, of course, invest in the stock market. I don't know much about cryptocurrency except sort of theoretically, but there's all sorts of coins being traded and exchanged. I think I might try and learn a bit about that, because it seems that whereas, the stock market gives you nice patient returns of about, if you're doing well, 20% a year, cryptocurrency can give you 20% in a week. So it seems sort of fairly
at the moment.
So at the moment, yes, who knows where it will go. Maybe Bitcoin will, as Phil just said, go to $1 million. And if it does, there will be wall-to-wall coverage in the financial press about how, so-and-so person was earning sort of $1,000 a month in January 2021 and is now a crypto billionaire or something. And everyone will think cryptocurrency.
His name's Akhil. He wrote a book on property, but he didn't publish it because he was doing so good in crypto.
Yes, we published in the blockchain. And so, there are. I would also. Just to go back a little bit to the point. We'd be wrong, or where might things slightly differ in terms of timing. I think the 1920s is a good example, and people have started to compare the two decades. And it is possible that there's so much money that goes into the markets over the next 5 years that things get extended a little bit. Maybe the real estate market doesn't have a really strong final couple of years, but the stock market does. You might get something like that. Maybe the fact that China will be probably by the middle of the decade quite clearly and widely acknowledged the biggest economy in the world might change things slightly, because the Chinese government has a bit more of a hold on what people and businesses can do. And there's always going to be something that makes things appear different, and it's when people are convinced that we're wrong that I think will be the most correct.
Can I say something before you answer your part of your question, Phil? Something you both said to me in this video is people being all in. And so in Australia right now, Australians have saved $125 billion of additional household savings on top of their normal. They've taken $35 billion out in super that has yet to be put back into the economy. And then you've got the Australian government printing legitimately hundreds of billions of dollars. People aren't all in yet. And I think that's an important distinction that I think you guys have made, because you're sort of suggesting that as we get close to the top of the cycle, people are going to be scratching around for anything they can to get the money into wherever's making the shortest and easiest and largest return, in the hope that it's just going to be like the people they talked to 3 years ago that did it 3 years ago at a better time.
Yes, yes. Ben, it's pretty easy for me. I'll be looking for the best breaks in the best stocks, in the best stock market, and I'll be telling all my members and subscribers all about it.
The best stock market being the States at the moment, still, from your perspective?
If Australia charges into new highs, it'll be pretty good for Australia.
Awesome, mate.
Yeah.
Is there anything else either of you guys wanted to round out the conversation with here?
Get educated. All right? Get educated. Tell your people. I tell mine all the time. Just get educated. Understand what the structure of the economy is. You do that by studying land.
The Secret Life of Real Estate and Banking, guys. Yes. Subscribing to Property Sharemarket Economics newsletter, or even, programs that you guys offer. Is there any other reading? I know you love Gann. I know that you and Fred Harrison have a relationship as well. Is there anyone else they should be checking out that's worth having a look at?
Yeah, Akhil's book coming soon.
Definitely. Will they be able to pick that up, Akhil? And when will that be published?
Yes, so the book will be out hopefully in October or September this year. I've yet to have fun, should we say. It's going to be published by Harriman House, and it'll be available on their website, or as both you can buy a physical copy or an ebook.
What are you calling it?
I don't know. If your readers have got any suggestions for what to make them buy it, let me know, because I haven't got a final title. I mean, when I pitched the idea to them, I called it the Secret Wealth Advantage. The idea being that if you understand the cycle, it's a tremendous advantage, but not many people know about it. But I think we can do better than that. So please do get your listeners to write in with any other suggestions.
If anyone's got suggestions, put them in the comment section down here. Thank you again so much, guys. Highly recommend everyone to subscribe to Phil's channel below, to share this with someone that needs to see it, and to just get educated. It really isn't that difficult. Like, you guys say this all the time, and for people that are just coming across the information, it feels like a lot, and then you hear the same thing repetitively from you guys for a couple of years, and it just all starts to make sense. What I've said to a lot of people that I've been speaking to is, Phil and Akhil sort of tell me this is coming 9 months before it does, and then Commonwealth Bank, Westpac Bank, Macquarie Bank come out about 3 months later with a prediction 6 months before, and then the Australian government sort of comes out with something about on time, and then the media comes out about 9 months later. So it's a huge advantage by having just someone else's finger on the pulse that's so obsessive with this stuff, like you guys are and like I am as well, to just get ahead of the information and just to collect it and make better decisions earlier. So thank you guys. Appreciate it.
You're welcome.
Thanks,
cool,
man.
Bro. Yeah. Oh, sweaty. So sweaty.